It's time for the bond markets now. Compared to the ranged behavior in the stock market, the bond market has seen major swings in May compared to its own previous standards. The 10-year bond yield, for instance, has fallen a full 50 basis points from their March levels to May. And now the yield is firmly under the 7% mark. After the two soft inflation readings in both India and in the US, India's swap market is also pricing a cut by the Reserve Bank as early as October. In sharp contrast, the near-term liquidity in the market has actually tightened. Again, similar to the US. Rates that banks pay one another for one-day money, that's called call money, actually shot up to 6.8%. Normally, it should be close to the repo rate of 6.5%. Of course, even this rate has cooled. Now, the price of money in the bond market ultimately determines the cost of capital for corporates and in a way for you and me. And so, for a 360-degree perspective on the interest rate outlook, I have with me B. Prasanna, Head Global Markets Group, ICICI Bank, by far one of the best veterans in this market. Prasanna, thank you very much indeed for joining me. Well, first up, this steep 0.5% cut in the cost of capital if you're borrowing from the bond market. Is it here to stay, the sub 7% 10-year yield?
I think, Lata, very quickly, if I have to recapture why the bond markets have rallied. If you remember, there was a surprise hold by the Reserve Bank. And even though the governor actually emphasized it's a pause and not a pivot, the market started believing that it was a pivot because of a few things that happened. First was they brought down the inflation projections itself to 520, which led to an ex-ante real rate of 1.3%, which looked high enough. And then beyond that, the actual inflation readings that came subsequently were very much in line with markets' expectations. In fact, slightly better, I would say. And the April reading at 470 kind of further increased the confidence. It was quite obvious that the incremental momentum, the month-on-month momentum in inflation also was kind of coming down, not only on the headline level, but also on the food and the core level. And also what has happened over the last 2 weeks is, let's say 3 to 4 weeks, is the fact that the Fed peak is now very close. And there is a greater confidence that the Fed will not keep hiking beyond maybe just one more hike. And last but not the least, confidence of India's external sector. The INR does not look, vulnerable. Of course, short-term concerns apart, from a medium-term perspective, the INR looks quite positive. So from all this perspective, the possibility of a rate cut this financial year is something that the market has started expecting. And also, there have been some technical factors, like you have pointed out, insurance companies, mutual funds, corporate treasuries, all of them actually buying, and much less duration supply in Q1. So all of these fundamental and technical factors have led to the rally so far. Now, to answer the question as to whether going forward, whether it's going to be sustained below 7%, I think a lot of factors are still needed for the bond markets to continue the rally. I would say that we would possibly be in a range of 6.9 to 710. I find it very difficult to believe that bond yields will go below 690. What I would rather believe is that there is possibly going to be a steepening of the curve. What the factors are that are required for the bond yields to actually fall below 690, I would say, are things like a stance change from the Reserve Bank. Is it going to happen in June? Well, I do feel there is a chance that they will, remove the words withdrawal of accommodation in June, but that has to happen. That is one. Sustained demand from investors is another thing that, it should continue. We have to see that in auctions and all that. And of course, some sections of the market are speculating OMOs and a lot of talk of OMOs coming. While we do feel that it's a little far-fetched at this point of time, OMOs are likely only at the second half.
Okay, Prasanna,
so long story short.
No, don't answer all of the questions I have in my mind in one go. Give me a little bit of time so that we get things a little step by step. Now, you're saying that the yields, you're expecting it to be 6.9. Now, one of the big reasons, and that was the last reason you pointed out, insurance companies had a bunch of money which they had to put in because of the tax change. Now that tax change is gone, there is no advantage for some people, very rich, very big investors in insurance, to put money in high-yielding debt, in some insurance policies. That money is not there this year. Secondly, HDFC Bank is now well satiated for HDFC merger. So two big buyers are not there. So that's why my worry whether we will go back above 7, before the half year is out.
No, it's quite possible that that's why the range of 690 to 710, Lata. I think it will not go below 690 because of all the reasons that I said, and enabling conditions need to come. And the reason I've given 710 as the upper end is for the reasons that you have said. Number one, the best part of demand, like you pointed out, from insurance and mutual funds, and the best part from a supply perspective is both behind us, because the supply in the first quarter is much lower than the supply in the second quarter. In fact, second quarter supply is as much as the entire second half supply of this financial year. And there is quite a possibility that demand from insurance companies and mutual funds will definitely taper down. Though I do believe that the demand from insurance companies is not just related to the March, tax change, and they got in a lot of money and hence they went and bought. I do think that over a period of time, the insurance companies have also kind of figured out that they are underinvested with respect to what their liability duration is in terms of what their asset duration is. So to some extent, I think they are catching up on their underinvestment of the past years. So I do think that the demand from insurance companies will continue, but it will not continue at the frenetic pace at which it happened in the last 2 or 3 weeks.
Oh, no, that's a very important one. They were doing FRAs with your forward rate agreements, warehousing bonds, as it were, and you're saying that that can continue. Okay, Prasanna, now let me come to the liquidity issues. Are you expecting at all that the Reserve Bank will do open market purchases? Because that will run counter to withdrawal of liquidity. Yes, of course. As long as there's withdrawal of liquidity in the stance, they cannot give liquidity when they are withdrawing liquidity. But if the stance changes, you think there is a possibility? Or will they prefer a CRR cut?
No. So I think in my order of preference or priority, I would place the stance change as the first thing that needs to be done before they think about infusing core liquidity. And between CRR and OMO, I would place CRR on a higher perspective, primarily because if you remember, CRR was in the pre-COVID days at 4% and it was brought up to 4.5%. So while at 4.5% now, as we go forward and RBI gets into a easy money stance or gets into a neutral stance, I think it's maybe right on their part to bring down CRR to back to the old level of 4%. OMOs is going to be a slightly more tricky question. While people do expect, and there are various expectations that they will come and do open market operations this year, but those will have to, in my personal opinion, wait for the second half of this financial year. RBI will want to look at infusing liquidity through FX operations, because now that money has started coming back in through the FPI route as well, and CRR as the first two preferences for them to infuse liquidity before they really get into the prospect of doing an open market operation. Okay.
Actually, it looks like my producer is prompting me to ask you about the RBI dividend, but I'll just finish one more question before I come to the dividend. You're saying that yields have clearly fallen in the bond market from 7.45 to 6.95 today, 0.5% fall. Now, what has it all gotten passed on? Has the Reserve Bank's rate hike cycle gotten passed on? Or for me as a home loan payer, should I expect one more round of EMI increases or something like that?
So, Lata, I think markets always react first, right? And so markets to some extent are expecting that the Fed has peaked. So the RBI has peaked, and the market in the US is expecting the Fed to cut rates. So if that happens, then the RBI can also cut rates. And so the the market is kind of upfronting all these expectations. And in its might, the market can go wrong and, has the flexibility to change its stance, and, yields can go back up if any of these expectations turn out to be wrong. But when you're talking about the banking system, when you're talking about deposit rates, when you're talking about lending rates, it's a slightly more longer term picture that you have to take in mind. So while we do feel that the interest rate cycle has peaked, we are not yet sure about when the rate cut cycle will start. In fact, I also wanted to mention that while the market, in the OIS market, is predicting a rate cut sometime between October and December, we actually still believe that it's too early for the RBI to cut rates. And that's also primarily because we believe the Fed has peaked, or probably one more rate hike is there, but they'll remain on hold and they won't cut rates this calendar year. And the market there will have to price out the rate cut sooner or later. So from that perspective, if you assume the Fed is going to be on hold, if you assume RBI is going to be on hold this year, and you know that, I mean, credit is growing at a reasonably good rate and deposit mobilization has been a challenge, though it has been coming in quite fast of late. And with small savings rate also on the higher side, I very much doubt whether we are going to see a cut in all the, loan rates and deposit rates as soon as what we are talking about.
Will there be another hike in home loan is all I'm asking.
No, I mean, we have to, I mean, that is something that has to be decided based on, I mean, in any case, last 2-3 months, Lata, I think competitive pressures were enabling, was making sure that, rate hikes on the loan side was not happening as much as what it could have happened based on RBI actions prior to this policy. So to some extent, I think there is a salutary mechanism on the way
up. Cost of capital has peaked is all I want to know. For a corporate,
cost of capital, right? I would say corporate, it has peaked. Whether it is going to go down more or not, only time will tell because of all these other factors that I was talking about.
No, fair. For a home loan buyer, I think so long as you know the peak, I think it could be a bit of an incentive. Well, very quickly now, RBI the dividend. I think the overall dividend I'm looking in, I think the government was expecting 91,000 crore from all sources put together. I think RBI was expected to give much less. I remember 48,000 crore, but I could be wrong. What is the street's expectation? How will it impact the market?
Yeah, so street's expectations as far as RBI dividend is concerned is all over the place, Lata. It is ranging from something like 90,000 crores to all the way to even 1.5 lakh crore. And that's because of the way RBI's accounting happens and the way they are allowed to pay policy. There are some assumptions that you have to make, because of which I think there are some changes. But broadly, what I would say is that it's a reasonable assumption to make that it will be upwards of maybe around 80 to 90,000 crores. It will be upwards of that number. One, because there has been substantial revaluation gains and realized gains in the forex market operations of the Reserve Bank of India. The balance sheet has not grown beyond maybe 1 to 2% this year, in which case they don't need to really put that much in contingency reserve. And also, maybe a little conspiracy theory that this could be, the last year before election. So any good dividend payment can come in handy from a government spending perspective. And I think the government is definitely going all out in terms of, infrastructure development and all these other things that they're doing, which actually enables them to the railways, the electrification, and so on and so forth. So that really will help them in keeping up their, fiscal spend on to ensure that the growth is, supported. So I would assume it's a little bit on the higher side than 90,000 crores.
Okay. My bet is that the dividend will work out to about 1.5 trillion. But they will pay only 1 trillion as surplus because they would want to shore up the capital, which is, dibbly-dobbly by the Bimal Jalan recommendation. Very quickly, just a very quick answer. When is your rate cut expectation? Because inflation is clearly below RBI trajectory. 5.1 for the current quarter is not happening. It will be like 4.9 or 4.8. And for the full year also, I think estimates have now come down below 5. So, rate cut.
Yeah, so that's what I briefly mentioned, that we don't expect the Fed to cut this calendar year, and we don't expect the RBI to cut this calendar year. I would assume my higher probability expectation would be for April, but maybe February also is something that cannot be ruled out.
Oh yes, pre-election. Thank you very much, Prasanna, for giving us a many-sided perspective of the bond market. Sign off on that note with stock markets in the red, but Chartbusters will take that action forward.